Good morning, everybody. I'm just going to leave it for 30 seconds just while some people are joining in the background. But in the interest of time, I might as well start with the introduction. So thank you all for joining what is the final session of our three-part international mobility series. Today, we're going to explore, still with a private client overarching theme, but we're going to be looking more at the corporate side. So we're going to be exploring the crucial role of global company formation and management in helping SMEs and larger corporations expand their international reach. Now, obviously, at the top of all of these companies, or most of these companies, there is an individual or individuals, and Lawrence will be taking us through some of the implications of that later on. But to begin with, we're going to be starting by looking at the market entry services corporate setups that we can assist with clients across the group and across the world. In today's rapidly evolving landscape, it is more important than ever for companies to stay informed about local regulatory requirements, legislative changes, and geopolitical factors as they grow their businesses overseas. So, with that in mind, and with recent news and headlines in the back of our minds too, in this session, we're going to cover expanding into the Middle East, potential strategies for doing that, potential jurisdictions that you could set up in, as opposed to just, as often is the case, people looking at the UAE or Saudi. There are other options. Using Mauritius as a gateway into Africa, establishing a presence within the European Union, setting up in the UK, and encompassing all of that employee retirement and savings programs. So without further ado, I'll just ask you to move on to the next slide, please. We've gone through, during the last couple of sessions, we've gone through this wheel, which you can see on the screen. And today we're going to be covering the two at the top left, corporate establishment and management, and pensions and retirement planning, which means we will have covered all of these different topics. Now, we will have time for Q&A at the end. And we have taken on board a lot of the feedback that we've had from the previous sessions, and we've been in touch with those of you who have asked questions. But if people do have any comments on any of these sessions, on any of the topics that we've covered over the last three sessions, including today's, please do get in touch, and we'll be very happy to have a consultation with you over the phone or over Teams to take your inquiry forward. So I'm going to start with the first slide. I'm going to pass across to Jade Wong, who will take us through company formation in the Middle East, which is obviously very topical given the recent events there, although thankfully things seem to have calmed down a bit. And then I'm going to pass across to Simon Denton and finally onto Lawrence Lancaster. So to begin with, I thought rather than going through this slide, which is rather wordy, I thought I'd use an example. Now, this example is based on a client that we've had, but I'm obviously not going to mention any names. So XYZ Limited, a mid-sized renewable energy company based in Germany, decided to expand its business internationally to meet the growing demand and strengthen its global presence. So first of all, they needed to set up a new company. So instead of just opening a branch, XYZ Limited established a wholly owned subsidiary in the UAE to tap into the Middle Eastern market. Through the UAE, they could expand into the other GCC jurisdictions where they also had potential customers. The new entity helped them access this new market, new customers, increase revenue, and build their brand in the region. Now, by operating in Germany, the UAE, and later in Mauritius, they managed to spread their risk, and XYZ minimized these risks tied to political or economic instability in any one country, protecting its global operations. Further to that, there were tax and financial benefits to this expansion. By structuring its corporate group, it took advantage of favorable tax treaties and optimized its global financial management, improving overall profitability across its worldwide operations. It also, by expanding, it provided it with operational flexibility. The new offices in the UAE and latterly Mauritius allowed XYZ to diversify its supply chain, attract skilled local talent, and implement advanced technology systems across borders. Finally, moving to the end of this slide, effective management and compliance, which is obviously key. XYZ appointed expert local managers to ensure compliance with each country's legal and reporting requirements. They maintain strong corporate governance to meet tax residency rules, enabling smooth operations and proper asset protection, avoiding risks related to nominee ownership. So this example, which I've just given, XYZ Limited, the approach that they adopted by using multiple different service lines and expanding into other jurisdictions across the world allowed them to expand successfully, but also allowed them to manage the complexity, risks, and opportunities that global expansion bring with them. So hopefully that just gives a little bit of an overview as to what we're going to be covering in today's session, which is obviously on this slide today. I'm going to pass across, as I mentioned, to Jade Wong, who's just going to give you a quick overview as to the expansion opportunities in the Middle East. Jade.
Thanks, Nick. Yeah, just a short introduction to myself. My name's Jade and I'm based in Abu Dhabi in the UAE. I've lived here for around about 13 years now, and I've assisted companies to expand across the Middle East over the past 8 years or so. So today what I'll do is introduce you to some of the support we can offer across the region and provide a brief idea of what you can consider if you're thinking to set up an entity in the Middle East. So if we move on to the next slide, I'll just introduce you to where we're located first of all. So we have offices across the UAE, Saudi, Oman, Qatar and Bahrain. And what we do basically is help companies to get set up. We help with visa support, we help with golden visa applications as well. Sovereign are also registered with financial hubs in the UAE, such as Abu Dhabi Global Market and DIFC. So we can help with the likes of foundation setups and SPV, holdco setups, structuring advice as well for individuals who are looking at options for succession planning. Other support that we do offer once companies are set up and running is internally we have the resource and the expertise to help with the likes of HR, payroll, and accounting support, as well as corporate secretarial support. We can also act as a authorised signatory. So often in cases of company setups, you need someone holding a residency visa. So we can actually act as an authorised signatory for companies to get set up and running. And if we move on to the next slide, just an insight into the UAE in particular. So what some of the key benefits to think about, obviously it's tax friendly, 0% income, there's only 5% VAT and 9% corporate tax, so it's very competitive. There is also dual tax treaties across a number of different countries, including Mauritius, which I think we'll touch on later on. And the infrastructure in the UAE, you know, there's over 50 different free zones to choose from, and they all specialise in various sectors such as manufacturing, media, distribution and financial hubs, as I mentioned earlier, Abu Dhabi Global Market and DIFC. There's lots of incentives that have been introduced over the years. A couple of years ago, 100% foreign ownership was announced, as well as reduced government fees. And I think this is all down to the long-term goals of the UAE to build a safe and secure, sustainable economy. There's even been extended visa options, as I mentioned earlier on, for individuals. So golden visas, retirement visa options, and also freelance licenses for individuals who might just want to set up a simple license and look at their options across the UAE. If you're looking to set up a company, often you'll be thinking about onshore or mainland options versus free zone options. What I would recommend considering if you're looking at the two options is who you're going to be working with. Are you working with government departments, for example? Are you working with private sectors? Are you just working internationally from UAE? And what are your activities? Is it simple consultancy? Are you trading? All of these factors will determine whether a mainland or a free zone option is best. So, for example, if you're trading and you want direct access to UAE, I would probably say consider a mainland setup. Whereas if you were just consulting internationally, you could also consider a free zone setup, which can be very affordable in comparison. Some of the key considerations that you'll probably think about is tax and some of the long-term considerations as well in terms of compliance and the maintenance of the license. So often companies forget that there is a requirement to register for corporate tax, regardless if you're in a free zone or onshore. So all companies across the UAE do need to register for corporate tax. It is mandatory and it needs to be done within 90 days of issuance of the license. VAT registration obviously can be done once you meet the threshold. And some free zones, a lot of people tend to ask me, am I exempt because I'm a free zone company? Am I exempt from corporate tax? Now that is not always the case for free zone companies. So I would advise you to get tax advice if you are considering a free zone option opposed to a mainland setup if it comes down to corporate tax. So there will be a number of factors to consider to check if you are exempt, such as your activities and who you're working with. And then other considerations is payroll. So all onshore companies have to register for what's called WPS, Wage Protection System. That basically monitors everyone's salaries, make sure everyone gets paid on time, and it has to be registered through a local bank account. So it is important to consider that early on because obviously you'll need a signatory to open the bank account and get that up and running. And you don't want to face any fines or you don't want to face the company getting blocked if you're not registered. Now, a signatory is always important to think about. I mentioned earlier that sometimes it depends on the setup, but often you need someone holding a residency visa to get the company set up and running. But also it's really important to consider that for other purposes, such as signing a lease agreement, signing for the bank account opening. Who are you going to appoint to act as that signatory? In terms of office space, sometimes onshore can be a good option because there's lots of affordable options in terms of the space, especially if you need larger space and you're planning to hire more staff. Free zones, however, do offer really affordable packages as well, and sometimes they include it as part of the package. So there's lots of considerations, but I would say, going back to what I mentioned earlier on, is think about what you're working with, think about what you're doing, and then you'll more than likely come down to the best option. And then moving on to the next slide, just some of the free zone options. There's many to choose from across the UAE. I think I mentioned earlier there's over 50 different free zones to choose from. Normally, Abu Dhabi Global Market and DIFC can be seen as the most popular choices, but it can depend on what you're doing and the type of entity you intend to form, who you want to work with as well. But Abu Dhabi Global Market and DIFC tend to offer some key benefits, such as English common law, well recognised globally. But other free zones as well are worth considering too. So we've got the likes of Kizad, which offer very good manufacturing facilities. Mazda offer very good energy-related activities. RAK ICC is another offshore area which offers affordable options if you're looking to set up a holdco, for example. So there's lots of options to consider. And again, I think it comes down to what you're doing, who you're working with, and what your budget is as well. Then moving on to the next slide, some of the key requirements to think about. Now, I always mention from the very beginning is, who is the owner of the company? Reason why is obviously individual ownership will be very, very straightforward. However, if it's a corporate owner, what you need to consider is having all of the documents of that corporate entity legalized in the country of origin. So preparing all of those documents, getting them translated, and making sure you've got all of that in place. But also going back to the signatory requirement, often if you do have a corporate owner, you'll more than likely, especially if you're setting up onshore, you'll need a signatory holding a residency visa to get the company set up. So there's lots to think about. In terms of timeline, you're probably looking at about, as long as the documents are ready to go, you're probably looking at around about 4 weeks for the setup. And for visa processing, around about 2 to 3 weeks. And the individual does need to be in the country during that time. And then they've got a 2-year residency visa. And then moving on to the next slide is just a brief overview of the other countries that we are based in. KSA, again, 100% foreign ownership is possible. As long as you have a corporate owner which has at least 2 years profitability. There's lots of activities to choose from. The opportunities are expanding by the years. And then Qatar, we also have an office where we can help you to get set up. Mainland options, free zone options, 100% foreign ownership is also available across many activities, as well as Bahrain and Oman. Bahrain seems to be a very popular option at the moment as well, because bank account opening can be very easy, and it can also provide access to Saudi. And then just moving on to the last slide, what we do. So basically, we have the expertise internally, and we have the resource. So as I mentioned earlier on, sort of the after support that we offer for companies once they're set up and running, it's very important to consider all of the long-term considerations. So the HR, the payroll, accounting, the corporate secretarial support. We have the people on ground with the expertise, but also in terms of the company setup procedure itself, it can be hard to navigate across this region. There's lots of government departments that you have to visit. So we will basically save you the hassle, help you navigate across those various different departments and help you with the full process. So we do have the resource and expertise, and we can help you from A to Z.
Jade, just very quickly, obviously we've witnessed the last couple of months of unrest in the Middle East. It might be called the elephant in the room, but we at Sovereign, we've seen businesses being pretty positive during this recent period. We've seen a couple of projects put on hold. Being on the ground, I mean, how do you see the current situation, and how much has it affected clients? And now that things are clearing up, do we expect to see it get back to normal very quickly?
Yeah, definitely. I mean, at first it was quite a surprise to all of us. And I think for the first week was definitely, a quiet week for us. But I would say, actually, even whilst, there was certain things going on for a good number of weeks, I think for around about 7 weeks, there was actually only a few hold-ups. And ever since, we've only seen new inquiries coming in. So there hasn't been much of a difference for now. And we're only seeing more and more companies actually looking to expand. And I think especially for companies who have a long-term vision, they understand what's going on, and they understand that the GCC region, it stands strong. And there's also lots of incentives for companies to support them. Also for existing companies already set up here in the region, there is a lot of support.
Sorry, I was muted. Apologies. Thank you, Jade, for that. I think now we're going to move on to Africa. We have often seen the Middle Eastern countries used as a gateway for companies looking to expand into other regions in the world. But we are also seeing more and more Mauritius as a gateway for those companies that look to enter Africa, which is, of course, a continent of 54 different countries. So Simon is just going to take us through this slide and tell us about Mauritius as a gateway to inward investment into Africa. Simon.
Thank you, Nick, and good morning, everybody. Just to let you know, there's a Q&A tab at the top of your screen. Try and use that. If there's some easy, straightforward questions, we'll take them as we go. And there's hopefully 10 minutes at the end for a general Q&A session. And just to remind you, this webinar, like the last two, are being recorded. So you'll get access to the link and the other links when we send you an email to the 246 people that registered. Thank you all for registering. Mauritius, gateway to inward investment into Africa. There is a link between what Jade has eloquently mentioned, getting off to a good start. There are tax treaties between the UAE and Mauritius, Qatar, and the same for Kuwait. So clearly there is a lot of business being made between those 4 countries, and more treaties are pending to be, or looking to be signed with the other GCC nations. So there's movement of people, movement of goods, movement of trade, foreign direct investment going between the two. That's why tax treaties are essentially created. So a little bit of a link. Take a group that is becoming international, or a Middle Eastern organization that wants to access Africa. We always talk about Middle East, North Africa, or Middle East Africa. There's some intrinsically very useful links and connections. But Africa has a future growth of 4%, and it produced last year 2.83 trillion in global GDP. Youngest population in the world, rich in natural resources, and it's got the biggest free trade area. Mauritius, clients tend to steer their foreign direct investment into Africa via Mauritius, a bit like Jersey, Guernsey, Isle of Man is to bring FDI into the UK, and setting up in the EU, which I'll talk about later. Getting a footprint in one of the 27 member nations give you access to the 27 member market. Mauritius is useful. It's common law. It's stable. It's low cost to set up and deploy resources there. The tax rates are favorable. Generally, the trading company tax rate is 15%, but I'll go on to explain in a minute what the beneficial tax rates are on the next slide. But there's no capital gains tax, there's no inheritance tax, minimal dividend withholding tax, no withholding tax going out of Mauritius. So it's rather important that a Mauritius company is established as a regional headquarters for an investment, an operation, a business, a trading company, even a joint venture or representative office as your gateway and your big foot into Africa. It's very good to put investment into Africa, but you want to get it out in a friendly, quick and succinct way. And building your business in Africa through a regional headquarters in Mauritius tends to facilitate a greater extent of trade, reduced barriers, reduced bureaucracy, notwithstanding its lower cost to set up in Mauritius compared with other nations. Next slide, Miguel, please. So again, you've got a Mauritius global business company. There's three types of companies really in Mauritius. There's the domestic kind, which is for in-country business deployment, in-country building of resources. That's when you just want to trade with people and companies in Mauritius. Doesn't stop you from trading outside. There's the BVI equivalent, the Mauritius authorized company. That's the offshore company that doesn't have a great deal of substance, and you cannot access the treaties, but you use that for perhaps on private client planning. And this one, the Mauritius Global Business Company, is your sort of corporate equivalent of having creating something in Mauritius for doing business in Africa or anywhere else in which Mauritius has signed a double taxation treaty with. Incidentally, Mauritius has signed positive double taxation treaties with the countries, ladies and gentlemen, on the left-hand side, Botswana through to Tunisia, and even countries in the EU have not signed so many treaties with, and the UK. UK and EU have not signed the same number of treaties that we have on the left-hand side, which is why a Mauritius onshore global business company able to access the treaties. It's tax liable, which makes it, yes, rather serious. It's tax resident. There's local directors need to be deployed and appointed. But incidentally, there's no capital gains tax. There's no dividend withholding tax. Usually there's 3% dividend tax on dividends being received from the subsidiaries underneath, but that could be relieved in full for certain participation exemption requirements, but no capital gains tax, no inheritance tax, and some very generous attributes in operating in Mauritius. Mauritius also offers some very attractive entrepreneurial programs, residency programs. So directors and shareholders wishing to relocate to Mauritius to administer, manage, and do business through Africa from Mauritius is quite a compelling argument. But here we've got a variety of options. When one is doing business with Africa to start with, they may just have a joint venture. But sometimes you're only as good as the partner you have in Africa, and they can facilitate the trade, enjoying a joint venture and a share of profits, which enables foreign direct investment to be deployed into African countries and other countries where Mauritius has signed a double taxation treaty. The next stage, there may be a need for go back, Miguel, please. Back. There may be a need for a representative office to be parked in Africa, a sales office, a presence, so that business continues through the joint venture arrangements, and there's no sort of permanent place of business in terms of invoicing and managing and being fully deployed in Africa until one decides that a trading company in Africa owned by a Mauritius company, especially in one of the example countries or one of the countries where the tax treaties are listed. I'm dealing with a client in Egypt, which has quite low corporation tax, but I'd want to bring the foreign direct investment through Mauritius and then outbound into Egypt. There's no restriction on who can own a Mauritius company, and the directors typically would be resident, but certainly Mauritius is a gateway to Africa and a gateway to undertaking trade investment, foreign direct investment, whether it be a joint venture, representative office, and in the future a trading subsidiary, are some of the reasons why Mauritius is used to very good effect. And we'll take questions as we go, but I think it's on to the next chapter, Nick, unless you've got anything else.
Thank you, Simon. If we could move on to the next slide, please.
Okay, I'll stick with the theme of dealing with a group that wants to become internationalized, or a group that may be privately owned and already is trading internationally, might not already be in the EU. That doesn't mean they are British. They could be Middle Eastern, Southeast Asian, American, or elsewhere, and establishing, expanding, or migrating into the EU to benefit EU freedom of establishment and treaty freedoms. Major block of countries in terms of projected GDP pre-Iran conflict of 22.5 trillion, one of the top 3 advanced economies, and 450 million of population to sell to. But being established in one member nation gives you the right to trade, access, and do business with major freedoms in all 27 nations, no trade barriers, freedom of movement of goods, capital, and often persons, and a company registered and resident of the EU with basic substance can access all of the treaty freedoms that I have specified. Typical example companies or domiciles that I would look to use, and we help clients trade throughout all member nations, and we help clients set up companies in all 27 nations. But the popular ones are Ireland, 12.5% corporation tax, although tax is not the main driver, but it's English common law, and there is lower cost compared to, for example, Belgium, France, and Spain. Cyprus, full member of the EU, of course, corporation tax maybe 15%, but there's some major compelling advantages for deploying intellectual property, patents, trademarks, copyrights, IP exploitation. And Malta has the lowest effective rate of corporation tax in the EU, being an effective rate of tax of 5%, but still giving access to all member nations. And that 5% effective corporation tax is actually accepted by the European Commission. So it's not a scheme. We don't peddle any of those. These are available to individuals, private groups, and companies looking to expand internationally and throughout the EU. Dividends paid out of an EU company into, or dividends and gains paid through an EU entity under the EU parent subsidiary, 9435, I believe, reduces or eliminates dividend withholding tax. Royalties, the same, reduced or elimination of withholding tax on royalties, and the same for loan interest. Yes, we've got to take some advice on a deployment of a company, a subsidiary, or a regional headquarters in the EU, and we've got the capability of delivering all of this, but the freedom of establishment, the freedom of trade being parked and set up in one EU nation gives you the ability to trade with the 450 million population, the 27 member nations, and pre-Iran conflict, you had $22.5 million of GDP. But let's go on to the EU illustration, please, Miguel. Next slide. And this is European Union market entry for a corporate that is expanding or wishing to expand in other countries in the EU by deploying substance and persons, executive and other staff, or a company seeking to be established in the EU because their headquarters or main holding company is elsewhere. They may do this for an existing company or a new company. The new company could be elsewhere, but also in the EU, because a lot of the EU member nations promote this parent subsidiary regime, which specifically avoids double taxation. But I'm going to concentrate on four. Cyprus, yes, a 15% corporation tax rate, but no dividend tax, no capital gains tax. And if you have a Cyprus company owning IP, intellectual property, exploiting intellectual property, developing intellectual property from Cyprus, you can, if it's qualifying, you can enjoy an 80% tax credit, which reduces your tax in the competitive field of Mauritius and others. There's also attractive residency programs, so executive, shareholders and other members of staff that wish to relocate to Cyprus, whether they're EU citizens or specifically non-EU, they are welcomed because there's fast-track residency programs available. English common law, and there's a non-dom landscape for executives relocating. So overseas income and overseas gains and overseas income not remitted to Cyprus are not taxable in Cyprus, a bit like the old-fashioned regime that the UK had for 200 years, but the current government abolished that, didn't they? Ridiculously, but let's not get into politics.
Simon, just on the remittance basis system in Cyprus, I think it's just important to note that it is quite narrow in scope in terms of the type of income to which the remittance basis applies. So yes, it does apply to dividend income. So if you've got overseas dividend income as a Cyprus individual, that is exempt. Sorry, that is only taxed unless it's remitted into Cyprus.
It's remitted.
If it's not remitted, it's not taxed. There are certain types of income though that don't fall within the remittance basis, and you just tax on a worldwide basis. For example, pension income, which is foreign.
It's reduced though, isn't it?
It is, exactly. It's effectively you're taxed on it on a worldwide basis, but the rate of tax is only 5%.
5%.
Yeah. So, but I think it is just worth noting that it's a bit of a misconception. It can be a trap, I think, for certain clients that leave the UK, where we had this very wide remittance basis system for almost all types of income. In Cyprus, it's narrower, so not all income benefits. But just going back on the corporate side, which you touched on, I think it's important to note, because you're coming on to Malta in a minute, but with Cyprus, if you're using Cyprus as an investment company, can often be more tax efficient than Malta. The reason being is that any income from what they term securities is exempt from corporation tax in Cyprus. So if you're investing in things like funds, shares, equities listed, unlisted, and you're receiving, or the company's receiving dividends, interest, and income from those investments, then that will be exempt, and they don't have capital gains tax, so the gains are obviously not taxed either. So you may find with a Cyprus investment company that it's more tax efficient than with Malta, but if you're using Cyprus for, say, trading, then clearly that's going to be taxed at the flat rate of 15%, although there are things that you can do with the shares.
Yeah, and also IP. System. And there's no capital gains tax. There's no capital gains tax in Cyprus per se, Lawrence, as well, which can be beneficial if you're selling a business.
If you're selling the IP, and as you've mentioned, the royalties from the exploitation of the IP, you can get a fixed ruling from the revenue authorities, and a common rate of tax there is effective rate is, as you say, 3%. So very attractive.
Thank you for that. Lawrence and I tend to deliver webinars and conferences, and we double up frequently in situations like this. You'll hear from Lawrence later. Republic of Ireland, many British companies use this for Brexit planning. Many didn't want to come out, but we voted to come out, didn't we? Perhaps a mistake. And the Brexit planning by moving a business into Ireland, a trading business, not very good for passive income and non-trading activities. The tax rate goes up 25%. But trading companies, even with the double taxation agreement, the positive one between Ireland and England, has caused business to flow through Ireland, especially for accessing EU member nations. Corporation tax, half of the UK, which is 12.5% on trading companies, and English common law applies. And there is a generous non-dom landscape, but advice would have to be taken on how best to use that in Ireland. But Ireland as a gateway, English common law, English language, and the robust financial services centre, and what Ireland has to offer as an educated workforce and a long-term member of the EU is quite compelling. Not just, of course, you may have started your company in Great Britain, the United Kingdom, but Ireland does offer some compelling benefits as a gateway and as a starting point for the EU. Moving on to Malta, yes, if you have technically a Maltese trading company owned by a Maltese holding company, forming part of an economic fiscal unit, you get to actually suffer only 5% corporation tax, especially relevant to consultancy, international trade, import and export, and a range of activities. Even if one of the owners or there's management and executives relocate there, the benefits of strategizing a Maltese double company trading and holding, you can still take advantage of the non-dom regime, and the effective low rates of corporation tax, lowest in the EU. Like Cyprus, major raft of double taxation treaties, not quite the same, not quite as much as the UK, but in excess of 50. Like Cyprus and Ireland, English common law, attractive jurisdiction for maritime, e-commerce, fintech industries, but there is really no restrictions to access those benefits in Malta through the corporate services that are available. Educated workforce, English language spoken, low tax, and it's not just the tax that makes Malta worthwhile. It's quite a compelling jurisdiction to use for EU and rest of world trade. So Malta, nicely fitting in with Cyprus, and we've even had situations where there's a Cyprus trading company owned by a Maltese holding company, and vice versa, an ultimate entity in Cyprus for special occasions. We've got to list Portugal as another gateway to delivering through the EU, and that's because Portugal have just effectively launched not so long ago their new version of a non-habitual resident regime, NHR. It doesn't really make sense, the title, but it's called version 2 non-habitual residence regime, And this really does apply to entrepreneurs, business owners, management, key executives, private private limited company groups that may wish to move from one EU jurisdiction or one high tax European jurisdiction to Portugal, even applicable to non-EU persons, non-EU companies, as long as a Portuguese company, a Portuguese trading company is created and it works in tandem with a current overseas company, and the overseas company might continue to procure international business, international trade. The Portuguese company is the company that employs the person relocating to reside in Portugal. The Portuguese company has to undertake business with the existing company or with the client base and generates commercial trade and commercial profits. Yes, there's some corporation tax to be paid in Portugal on the profits that it generates, but the person relocating or the family relocating to Portugal to take advantage of what Portugal has to offer as a lifestyle, climate, safety, and the EU treaty freedoms, dividends, overseas dividends and overseas gains are not exposed to taxation. And the benefit of living in Portugal, doing business through the Portuguese entity, doing business through that Portuguese entity for EU market entry makes Portugal an attractive regime for entrepreneurs, private limited company groups, persons relocating to manage and own that Portuguese company, makes it quite compelling in line with that new non-habitual residency regime. Okay.
Thank you, Simon.
No questions. And I've just got one more slide before Lawrence comes in, I think. Importance of doing business and setting up operations in the UK. Yes, we're still important here in the UK, despite what I've said about Brexit and the challenges. It's still the premier world's leading financial centre. User-friendly business setup process, no minimum capital, one director, one shareholder, £1 of paid up capital, business-friendly environment, government support for certain investments, especially fintech and the industries and investment that are needed in the UK. Global business hub. But yes, we do have 147 double taxation treaties signed with the rest of the world, 3 times as many as most of the rest of the world, English common law, and still available immigration programs for those that did not know this or are not, or are being delegates that are not living, working, or from the UK. Lawrence, next slide, please. Lawrence, it's you for the next slide. The landscape of the UK tax landscape, Lawrence.
Yeah, thanks, Simon. Can you hear me okay?
Yes, I can.
Yeah, sorry, I was muted. Yeah, so part of this table is there for your reference. So the middle part of it were applicable to UK resident individuals. We're not going to look at that. We're going to focus on the corporate side, which is obviously the theme of today's talk. So UK companies still an attractive proposition for the international investor as part of a corporate group. You can see there that the UK companies are subject to 19% corporation tax, or on the first £50,000 of income, and then the balance is taxed at 25%. So still relatively low, although it has creeped up in recent years. We see there as well, which Simon has mentioned to date, 147 DTAs that the UK has concluded, which is, we've said, is more than any other country in the world. So I think in terms of the context, we're looking at an international global group. It's very important to look at how you're going to get money out of the UK. Dividends paid to an overseas company are not subject to withholding tax in the UK. That is a crystal clear rule that applies across the board. So even if your holding company is based in the Isle of Man, Guernsey, places like that, where the dividend will not be taxed in the country, in those countries, it will not be subject to withholding tax in the UK. There's no need to rely on a tax treaty there. That's just very straightforward. Dividends not taxed in the UK. In terms of dividends, not subject to withholding tax when they're paid to non-resident companies. In terms of how dividends are taxed in the hands of the UK company, well, the general position is that a dividend received from, say, a company that's based in Cyprus, Malta, somewhere else, and received by a UK company will house that taxed. The general position is that it is subject to corporation tax, and you get a tax credit for the foreign tax that's been incurred. However, most types of dividends now, where the paying company has concluded a tax treaty with the UK, will benefit from this distribution exemption. So the dividend, assuming the various conditions are met, but in most cases where the UK co holds a sizable share in the foreign company that's paying the dividend, as long as there's a tax treaty between the UK and that country, then the dividend should not be taxed in the hands of the UK co because of the distribution exemption. I think just one point to look at in terms of other types of income that are paid from a UK company to a foreign investor, a foreign corporate investor. Interest is the other big one. So we're clear that dividends that are paid from a UK co to a non-resident company, not taxed across the board. Interest, the general position is that interest, which is from a loan that's more than 12 months, has a term of more than 12 months, that's going to be subject to withholding tax of 20% in the UK. But then you've got tax treaties, which may block that off with a successful HMRC claim. And what we've been looking at, what Jade's been taking us through earlier, the UAE jurisdictions, the Emirates in the UAE. The UK has concluded a DTA with the UAE, which has an interest article, and potentially, if you're investing in the UK through a UAE company, say one based in Dubai, then with a successful HMRC claim, the interest will not be taxed in the UK because of the tax treaty blocker. In terms of gains tax, again, we'll look at how it's taxed in the hands of a UK company. General position is that gains that are realised by UK companies are subject to corporation tax, and most of the gain, or if not all the gain, is going to be taxed at that 25% rate, which may be worse than the tax that applies to individuals. However, and this is again what we're looking at today, corporate groups, we have this important exemption called the substantial shareholding exemption, where a UK company sells shares either in another UK co or an overseas co, and the various conditions are met, the gain will be exempt from corporation tax, which again makes the UK co an attractive proposition as part of a corporate group. In terms of the selling of UK shares by the foreign investor, there won't be any capital gains or corporation tax when you come to sell shares in a UK company. The only exception to that is where the UK co is property rich. There could be corporation tax on that disposal by the foreign investor. VAT, we don't really need to look at that. It's just there for your reference. And again, inheritance tax is a tax on individuals. It's not a tax on companies. But if you have got individuals within your corporate group that have exposure, then they'll obviously should be taking UK tax advice on that case-by-case basis. So I think that just gives you an overview there of the relevant snippets as far as the corporate group is concerned. And we can move now on to a tax comparator, which Simon's going to take you through, which are these very tax efficient jurisdictions that are very closely aligned to the UK.
Thank you, Lawrence. Excellent summary. And it's Guernsey, Gibraltar, Guernsey, Isle of Man are overseas territories of the UK, used exponentially and frequently. And I'm just going to give you characteristics as to why an international group, a private group, a group that is expanding, might locate themselves in these favourable jurisdictions for certain reasons. Now, in Gibraltar, a place I used to live, and I was the MD of our headquarters in Gibraltar many years ago, the first office that was established by Sovereign 38 years ago. Gibraltar, with their Spanish partners, Spain is a border of Gibraltar. they've just signed an EU treaty to ratify and offer a fluid border, and residents of Gibraltar will have free movement within the EU, unique to the whole of the EU, because Gibraltar is a dependent territory of the UK. So this is groundbreaking, unique, and highly relevant for persons that decide to relocate to Gibraltar, to become resident of Gibraltar, and to run their international operations from Gibraltar. And they'll still get not just access to Spain, but Schengen-style entry for the unlimited access to Schengen countries and freedom of movement across the EU. Gibraltar has a robust financial services industry. Even sovereign are regulated through the Commission to provide corporate and trustee services, but it regulates banks, insurance companies, financial houses. They've got attractive residency programs, low corporation tax, no capital gains tax, no inheritance tax, and qualifying residents have access to very interesting and useful low tax residency programs. A dependent territory of the UK, but that EU treaty that has been signed, set for ratification later in the year, is rather unique to the EU. Guernsey, Lawrence is going to be talking about international pensions, corporate pensions in a moment, and Guernsey is a premier location for private pensions, international pensions, QNUPs, etc., and corporate pensions, are offering a raft of benefits for a corporate to incentivize staff through pension and savings deployment. There is no corporation tax in Guernsey. It's outside, like Gibraltar, it's outside the customs union, and there's no VAT like Gibraltar. No local capital gains tax, inheritance tax. Our centre of excellence in the Channel Islands is Guernsey, high quality banking industry, and the Rolls Royce of the sort of Channel Islands. Isle of Man, by contrast, it is part of the UK for VAT, but only for VAT. Companies pay no tax, no corporation tax in the Isle of Man, with exception to banking and certain financial institutions. But it is a VAT area. A qualifying trading company through the Isle of Man Treasury receives a GB indistinguishable VAT number, but issued by the Treasury in the Isle of Man. And because of that, the Isle of Man is often a gateway to undertaking corporate investment of commercial property. That's non-residential dwellings, especially when the vendor is VAT registered. The Isle of Man company can be VAT registered quickly, and there's zero rating or transfer of going concern on the corporate commercial property. Premier jurisdiction for trusts, as is Channel Islands, Guernsey and Gibraltar. Well-known for financial services, fintech, maritime, gaming, international trading companies, because of the VAT situation, and being able to acquire a GB VAT numbering and quickly. Low tax rates for persons relocating to manage their corporate group from the Isle of Man. Quality banking centre, but those three give you, the three jurisdictions there give you a useful comparative analysis of the benefits, merits and characteristics of why for certain situations you would park, establish and put in place a Gibraltar company. They call it Gateway to Africa, gateway to another gateway to Africa, gateway to the EU, especially that new treaty. Guernsey, a premier financial centre, Isle of Man as well, with the VAT application. And given that we were founded in 1987, Gibraltar and Isle of Man jurisdictions were domiciles of origin for sovereign, and Guernsey celebrating 3 decades of service. Thank you, ladies and gents. Lawrence, retirement planning.
Thanks. I mean, I think it's just worth mentioning all those Yeah, okay, so I'll be quick on this. I think it's worth just mentioning those 3 jurisdictions all have concluded tax treaties with the UK as well, which makes them quite useful as holding companies, actually, where you've got underlying UK subsidiaries. So very, very useful, as you say, on a case-by-case basis. So moving on then very briefly to retirement planning, savings planning in the corporate context. So what do I mean by the corporate context? Well, it basically just means that it's the company that is setting up the retirement plan. So that would be in this context, a company within the international corporate group. It may be the group holding co that wants to set this up for the benefit of the employees that are employed by the underlying group companies. That's quite common. It may also be that one of the underlying group companies needs to set this up to meet its obligations under local law. So you'll see there this point about gratuity. A good example of that, and one that fits in with what we've been speaking about today, is Dubai and the UAE generally. They have this obligation on employers to provide for employees who have resigned, who've left, they've terminated employment. They have this obligation in most cases to provide a gratuity. So that can obviously provide be burdensome for the employer from a cash flow perspective if they've suddenly got to find this payment, got to make this payment out of their general income for the year or capital. So it makes a lot of sense if you've got employers who have these statutory obligations in the place they're doing business to have a trust-based arrangement set up to meet these future liabilities. So it's beneficial on the part of the employer because they've got really this nest egg that they can call upon to meet these obligations as and when they fall due. But it's also very attractive from an employee perspective because a trust-based arrangement in a jurisdiction such as Guernsey, which is blue chip, it's well regulated, it's established for the provision of pensions. Many years it's been used for this purpose by both employers and by individuals. It gives them a lot of peace of mind and reassurance to know that their savings, their retirement planning is safe. It's removed from the employer. You'll often see with these schemes, with these plans, that the employer is excluded as a beneficiary. And what that means is that the employer cannot actually get its hands on the fund that sits there in Guernsey. The only people who can benefit from that are the employees of the employer, or as I say, it could be from the whole corporate group. And typically the beneficiaries will be their family members who can benefit on the employee's death. But the point is that it's held by an independent trustee, ring-fenced in a trust in a different jurisdiction. That gives employees a lot of confidence that their retirement planning is safe, really. In terms of tax, traditionally, a contribution to these trust-based schemes would be a deductible expense on the part of the employer. So it would just be treated as making a normal payment of salary to the employee. That's the general position under basic principles, because the payment is wholly and exclusively for the purpose of the business. That's subject to anti-avoidance legislation, and as we can see in the UK, as some of you may know, you won't get a deduction in most instances now, where a UK employer contributes to a Guernsey-based employer-sponsored pension scheme, may do in certain instances. But that just gives you a flavour of Guernsey-based retirement planning and savings. If we could just move on to the final slide before we go on to questions. These just give you some indication of the benefits that these type of plans can provide. I've already touched upon these. It's obvious that it provides saving for life, which is, as I've said, it's in an independent trust-based arrangement. In Guernsey, it's possible to have these schemes either more flexible or more rigid, depending on the security that you want to offer as an employer, and depending on when you need to have access to these benefits. So if you're going down the route of meeting liabilities to fund future gratuities, you want flexibility, and you probably don't want to have a strict pension-based arrangement for that. On the other hand, you do get these, and as I say, for those type of schemes, you would just want it still to be based under trust, but not really very prescriptive pension-based legislation. But there are other schemes that can be governed by those provisions, by those stricter pieces of legislation, which again, where the employee is looking to actually provide for their retirement, you would probably want to have your savings based in one of those more rigid schemes. So it's a case by case. It requires tailoring for the needs of both the employer and the employee. In terms of the tax position in Guernsey, there's a tax exemption where the employee has not resided in Guernsey or worked in Guernsey throughout the course of their membership of the Guernsey-based pension scheme. So what that means is that in this context, where you've got an international corporate group using Guernsey as a retirement planning arrangement for its staff members, benefits that those employees receive from the plan will not be taxed in Guernsey because of this special tax exemption. So it makes it a really popular jurisdiction for international corporate pension planning. And again, to go back to some of the jurisdictions we've been talking about, I'll use Dubai again. I think Dubai does have some form of pension planning, but it probably isn't something that employees of an international corporate group who are working in Dubai would want to use. So they'd probably be a lot happier with their savings being held in a Guernsey-based scheme. And I think that does apply across the board with high net worth individuals that are working for corporate groups. Guernsey is a very attractive jurisdiction because of this stable legislation that it has, tried and tested over a number of years, and the fact that benefits are just not subject to tax because of this clear-cut exemption, and that's been the case for a number of years. I think comparing that to, say, with the UK, which just changes its tax legislation applicable to pensions by the minute, and we've seen, as we've been discussing in these webinars in the course of the series, that inheritance tax changes to the UK that are coming in next year. In Guernsey, you just don't see that with this very stable system to taxation that it has. So I think that concludes the section on the benefits of an international retirement plan. And on that note, we can now move on to questions, unless, Nick, you've got some final thoughts.
No, thank you, Lawrence, Simon, Jade. Very informative. We've run over time. We all can stick around for a few more minutes. If anybody does have any questions, please do put it into the chat or into the Q&A. But for those of you that need to jump onto other calls or to go to other meetings, while we just keep an eye on the chat to see if any questions come through, we will be sending through the presentation slides to you and to anybody that was unable to attend. For those AI note takers listening, we'll be sending through the commentary to you. If you have any questions, please feel free to drop us an email at those addresses that you can see on the screen now. We will be doing another one of these in the not too distant future. We've had a very good uptake to these webinars that we've done these last 3 times. So thank you so much for your support, and we look forward to seeing you on the next one. And
Nick, just a quick one. Those that didn't attend webinar 1, the first or the second webinar of the trilogy, all you got to do is send an email and we'll send you the links to both webinar 1 and webinar 2, together with the presentations, including this presentation and video link, which will go out to you this week, I hope.
Good stuff. Thank you, Simon.
And there's no questions in the chat room, Nick. So
unusually, no questions coming through. So I think we'll call it a day. And yes, as I said, look forward to seeing you on the next one. Thanks, everybody.
Thank you. Thanks for your comments as well.
Thank you.
Thanks, guys. Bye. Bye-bye.